Every cycle, there's a moment where almost everyone is on the wrong side of the trade. Right now, that's exactly where we are. Investors are calling bubbles. They're comparing Nvidia to Cisco. They're saying the AI trade is done. And in crypto, people are already writing postmortems on a bull market that hasn't even peaked yet. Tom Lee completely disagrees with all of that. In his latest interview, Lee lays out a simple, brutal message. We're in the middle of a supercycle almost nobody understands. Institutions are way offside and will soon be forced to chase into year end. Bitcoin and Ethereum still have massive upside if you're thinking in cycles rather than headlines. And the thing that actually ends this bull market isn't the halving or the Fed. It's a boring macro metric almost nobody on crypto Twitter even watches. If you've been in this market the last few years, you've heard the same narrative on repeat. The yield curve is inverted, therefore a recession is coming. Inflation means the 1970s are back, and the AI boom is just another dot-com bubble. But before we continue, just a quick reminder that only a small percentage of you watching are actually subscribed. If you're getting value from the videos, hit that subscribe button. It's free, it supports the channel, and you can always change your mind later. Let's get back to the video. Tom Lee's entire framework rejects that kind of copy-paste thinking. His team at Fundstrat has been running long-term supercycle models since the 2009 bottom, anchoring not to daily headlines, but to decade-long structural arcs. He argues that the current market strength was baked in long ago, driven by a combination of millennials entering their prime earning and spending years, a global shortage of prime age workers, and companies being forced to invest in productivity. Together, those forces naturally created the conditions for an AI-driven capex boom. From that lens, Nvidia isn't a freak accident. It's the inevitable result of a demographic and technological setup that echoes earlier booms. Lee points back to history for proof. Between 1948 and 1967, and again between 1991 and 1999, labor shortages collided with new technologies to fuel extended bull markets in tech. What we're seeing now, he argues, is exactly that kind of cycle repeating. While everyone else is obsessing over the yield curve and calling every rally a top, Lee is asking a different question. Is this what previous tech-led supercycles looked like? He believes it is. The AI revolution isn't a carbon copy of the late 1990s. It's a new phase built on real demand, real earnings, and real constraints. And that's why shorting Nvidia every time it rallies has been one of the most reliable ways to lose money this cycle.
What people have a hard time understanding and grasping are supercycles, because Fundstrat's work by nature is thematic. We look for story arcs that last 10 to 15 years. So the reason we turned structurally bullish in 2009, was because our cycle work showed that there was a long-term bull market starting. And beginning in 2018, we identified two future supercycles. One was millennials, and the fact that they're entering the prime age workforce. That was a powerful tailwind that would last up to 20 years. And the second was there was a global prime age workforce labor shortage. I know it sounds like plain vanilla to say that, but that was going to set the stage for an AI boom. So we're in the midst of an AI boom that is causing prices to levitate. But this is pretty textbook. In 1991 to 99, there was a labor shortage and tech boomed. 1948 to 67, there was a labor shortage and tech boomed. So tech is booming, and a lot of people look at stocks that have a high Sharpe ratio, right? They're just going up, and they assume it's a bubble. And so people have been chronically trying to short Nvidia every step of the way up. And then the second thing people anchor to is that, well, many people aren't really that old in our business. I was actually an equity research analyst during the dot-com boom. So many people are saying this is just like the dot-com mania. There's some similarities, but we're so far from it. But everyone thinks that this is big again.
What you just heard is the core of his worldview. We're not replaying 1999. We're living through an AI-driven supercycle that has years left to run. Zoom out from the charts and look at positioning. Over the last few weeks, sentiment has turned ugly. Government shutdown headlines have dominated. Liquidity has been pulled back. AI and high beta names have wobbled 5 to 10% in a single session. Retail investors look at a 3% dip in the S&P and start wondering if it's the top. Tom Lee is looking at something very different. He points out that institutions spent the start of the year positioned for Armageddon, expecting tariffs, a recession, and a broad market crash. That call was dead wrong. After a massive run in equities, Roughly 80% of institutional managers are now trailing their benchmark. It's the worst relative performance in 30 years, and they have only a few weeks left to fix it. And if you want to stay ahead of the market to spot when it's heating up or flashing those rare buy signals, join the Crypto Nutshell, my free 5-minute daily newsletter. You'll get quick, actionable insights and the latest news that actually moves markets, all delivered straight to your inbox every single morning. Just hit the first link in the description and enter your email to join. Let's get back to the video. That's the backdrop heading into year-end. Underexposed managers, extreme caution, and rising career risk. In other words, the perfect conditions for a chase. Lee explains that when everyone thinks there's a top, there usually isn't one. True tops form when people think stocks can never fall. Right now, the opposite is true. He argues there is enormous latent demand for equities simply because so many professionals are offside. A clean Fed cut in December, he says, wouldn't just lift the S&P. It would light a fire under financials, small caps, and high beta tech. And because crypto tends to move in sync with those sectors, it would almost certainly spill over into digital assets as well.
People have gotten pretty bearish in the last couple of weeks because the government shutdown kind of has deprived the economy of money. And then the Treasury Department isn't dispersing funds, so their liquidity has shrunk. And it's caused stocks to actually wobble. And every time the S&P is down 2 or 3%, or AI stocks are down 5%, I think people get really cautious. I think, first of all, bullish sentiment is not even anchored properly. People become so hesitant. I think everybody thinks there's a top. Here's the thing. When everyone says there's a top, there cannot be a top. The top in the dot-com was because nobody thought stocks could ever fall. They actually thought we were entering like an era of continued prosperity. The second thing to keep in mind is that markets have been strong for the last 6 months. There is incredible demand for equities because people are really offsides. That's what you have to keep in mind. In April of this year, people thought we were facing Armageddon because of tariffs, and you had many economists proclaiming a recession, and that's how institutions traded. They were actually positioned for a massive bear. They can't fix that in 6 months. So we're now getting into year end where institutions, 80%, are trailing their benchmark this year. It's the worst performance for institutional fund managers in 30 years, and they have 10 weeks to fix it. They're going to be buying stocks. And finally, visibility for AI has not even been affected by the government shutdown or anything. So companies are going to start, as they think about 2026, start making announcements. So I think in the final months, I think one surprise is the AI trade's going to come back strong because it's wobbled. But the Fed is getting people scared because is the Fed going to suddenly hammer down on things? But keep in mind, inflation has been softening. So if they cut in December, they're confirming they're on an easing cycle. Now that meeting's not for a few weeks, but that would be really bullish for financials and small caps. And by the way, what's correlated to tech and financials and small caps? It's crypto. So I think you're going to have a massive crypto rally as well.
The takeaway is that markets are entering a period where institutional fear could quickly flip into forced buying. Benchmarks are running away. Career risk is rising. The managers who played it safe all year will be compelled to buy the assets that have actually worked: AI, growth, and anything tied to easing liquidity. For crypto, that's the setup you want. Once you understand Lee's macro and positioning view, the next question is obvious. Where does Bitcoin fit into this picture? On Bitcoin, Lee says expectations have been dampened. Many of the early OGs have been selling above $100,000, and the price has been treading water long enough to kill the hype. But structurally, Bitcoin is still a massively underallocated asset class. Most investors barely have exposure, and that underweight positioning leaves room for explosive repricing once liquidity expands. On Ethereum, his tone becomes even more confident. Stablecoins are cannibalizing demand for both Bitcoin and gold. Tokenized gold is doing the same thing. But every one of those instruments, stablecoins, tokenized assets, on-chain collateral, runs on smart contract platforms. And the platform with the deepest adoption is Ethereum. Layer on top of that Wall Street's tokenization push and Larry Fink's declaration that he wants to tokenize everything on the blockchain. For Lee, that means Ethereum's growth expectations are rising sharply. When growth expectations rise, the discount rate investors apply to future earnings falls, which translates directly into higher prices today.
I think people have dampened their expectations for Bitcoin partly because Bitcoin's been treading water. And there have been a lot of OGs, original Bitcoiners that are selling above 100,000. But it is still an underallocated asset class. So I think Bitcoin actually potentially can get to the high 100,000s, maybe even 200,000 by the end of the year. I think it's a big ask. But to me, what's more obvious is Ethereum can have a huge move into year end, because even Cathie Wood wrote about it. She thinks stable coins have been cannibalizing demand for Bitcoin, and gold and tokenized gold is cannibalizing demand for Bitcoin. But stable coins and tokenized gold run on smart contract blockchains like Ethereum, and Wall Street is building, and Larry Fink wants to tokenize everything on the blockchain. That means Ethereum is where people are starting to raise their growth expectations. And if you're raising your growth expectations, then your discount to the future is going up. So I think that there's a bigger move in Ethereum. And Mark Newton, our head of technical strategy, thinks we can be like 9 to 12,000 by January. I think that's about right. I think Ethereum, just 3,600 more than doubles between now and year end, or between now and January.
In simple terms, Lee believes Bitcoin could climb into the high $100,000 and possibly even reach $200,000 by year end. A big ask, but one he sees as plausible. Ethereum, meanwhile, could more than double to between $9,000 and $12,000 by January. The key detail isn't just the numbers, it's the mechanism behind them. As traditional investors realize that tokenization, stablecoins, and on-chain assets all depend on smart contract infrastructure, they'll be forced to reprice Ethereum as the foundational layer of that system. So yes, high 100Ks for Bitcoin grabs the headline, but Lee is clearly signaling that Ethereum might be the higher, beta, more asymmetric leg of this cycle. This is where Tom Lee diverges from most crypto narratives. Ask a typical analyst where we are in the cycle, and you'll hear the same answer. It's the 4-year halving ribbon, and we're near the end. Lee says that's the wrong lens. He starts from equities. The S&P 500 has posted double-digit gains in 2023, 2024, and now 2025, likely around 20% this year. At the end of 2022, almost nobody was bullish. Many were talking about Armageddon. Wealthy individuals and hedge funds pushed clients into cash, private credit, and venture capital, only to watch public markets crush them. That misallocation is now forcing a reckoning. When investors finally accept they were wrong, that recognition usually marks the middle of the cycle, not the top. From there, he pivots directly into crypto.
2025 is the third year where the S&P will be up double digits, probably up 20% this year. So 3 years of 20% gains in a row. Okay, remember at the end of 2022, people were saying we were Armageddon. Nobody was bullish. So in the last 3 years, wealthy individuals and hedge funds recommended people go to cash, or they do alternatives like private equity, private credit, or venture. But the S&P 500 has trounced all of those categories of assets. So this is a comeuppance, because 3-year return, what is someone's excuse for basically maybe having flat performance or up 15% when the S&P is almost up 200%? So this is really the reason 2026 is probably not as bearish as people think, because now next year, I think people are going to be like, wow, wait, NVIDIA and all these are public companies, and their earnings are growing 50%. I think people are going to actually start chasing them next year. That's really positive for crypto, because, as you know, there is also this argument today that the crypto cycle is a 4-year cycle, so it should be ending now. So people are trying to fade that. I think people are trying to fade everything, the S&P and the crypto, but forgetting that the Fed is beginning to cut, and the ISM, and we've written about this, is more correlated to Bitcoin than monetary policy. And until the ISM gets to 60, Bitcoin really can't peak. So I think this is pretty positive for crypto. But crypto, it's kind of been hurt because, monetary liquidity hasn't been really increasing. The Fed has been under QT, quantitative tightening. That's ending in December. And the Fed hasn't really given clear signals that they want to ease. So I think there's been a little bit of confusion for investors.
Lee argues that the popular 4-year cycle model doesn't actually explain Bitcoin's behavior. His research shows that the ISM Manufacturing Index, a measure of economic activity, is more correlated to Bitcoin than monetary policy itself. Historically, Bitcoin doesn't peak until the ISM rises towards 60, a level that signals strong expansion. At the same time, the Fed has been running quantitative tightening, keeping monetary liquidity from truly expanding. That QT program is scheduled to end in December. The Fed hasn't yet sent a clear signal that it's shifting to a full easing cycle, which has left investors confused about where liquidity is heading. Put those pieces together, and you get a very different picture from the cycle's overcrowd. ISM hasn't hit 60 yet. QT hasn't fully wound down. Institutions remain underexposed and behind the curve. Lee believes that 2026 is probably not as bearish as people expect, because that's when the recognition phase will kick in, when investors finally realize they've been fading a genuine supercycle. As they chase AI, high-growth tech, and by extension, crypto, liquidity and momentum will surge again. The halving doesn't end the cycle, he insists. Liquidity and growth do. So, where does that leave us? Tom Lee's message, stripped of all the noise, is simple. We're in an AI and demographics-driven supercycle that resembles past technology booms far more than it does the speculative mania of 2000. Institutions are underweight, offside, and running out of time, which makes their fear the fuel for the next leg higher. Bitcoin and Ethereum still have enormous upside if you think in terms of structural cycles rather than daily charts. And the metric that truly matters isn't the Fed or the halving, it's global growth and the ISM. Until those roll over hard, this story isn't finished. The past few years have proven that mass misconceptions can persist far longer than people expect, but the earnings, the liquidity, and the data don't care what investors believe. The challenge is deciding what you're going to anchor to, the fear and the headlines, or the supercycle that's unfolding right in front of you. Because if he's right, the real lesson isn't to take profits because it's over. It's the opposite. Buckle up.